The fall of stablecoin Terra, as well as its sister token Luna, in 2022 knocked an estimated $500 billion out from the crypto market in a single week. And now everyone is speculating as to what might have caused the crash. Although many people have various hypotheses, the most prevalent one is that Luna is likely a Ponzi scheme. In this video, we'll look at the possibility of Luna being a Ponzi scheme. And we also share some helpful tips on how to identify a Ponzi cryptocurrency project. Hello, and welcome back. Following last year's crisis, which has repercussions across the entire cryptocurrency industry, the entire U.S. Securities and Exchange Commission filed a lawsuit against the designer of the defunct Terra blockchain platform for securities fraud. Kwon, a co-founder of Terraform Labs, and SEC's lawsuit alleged that they perpetuated a bogus activity that brought about a loss of at least $40 billion in market value. Online assertions that Terra has essentially been a Ponzi scheme were made leading up to the announcement and statement from the Luna Foundation Guard. And such conjecture even came before the coin's stunning collapse. These allegations have an air of reality, but as Kwon has continued to post updates on Twitter assuring UST holders who have already passed away that they will receive compensation, it also appears plausible that Terra was merely a very risky business venture. Given that many risky investments aren't Ponzi schemes in the most literal and technical sense, there isn't a simple, universally acceptable response to the topic of what qualifies a crypto project as a Ponzi scheme. Yet a disproportionate number of cryptocurrencies are operated like Ponzi schemes, with growth driven more by speculators than by actual expansion in user base. On crypto Twitter, a sizable portion of users appear to think that Terra was essentially a Ponzi scheme. Adam Black, Tomer Strolai, Trader Main, Brad Mills, the Singapore Police Force, and others hold this belief. Many rumors circulated that Kwon has dissolved Terra as a South Korean-based company, with an official document indicating that this dissolution occurred at the end of April 2022. This rumor was spread because of the uncertainty and absence of accurate details concerning the collapse. This clearly occurred a few weeks before the collapse, indicating that Kwon and Terra Labs were aware of its likelihood. Such assertions imply that Terra may have been a deliberate Ponzi, but there's no smoking gun proof that establishes this beyond a shadow of doubt. For instance, Terra Labs has been in existence in Singapore since 2018. Terra was not a deliberate Ponzi, but it doesn't mean it wasn't a Ponzi-style investment vehicle. Before we continue with the rest of the video, check out and watch the other videos on this channel, leave us a like, and share your thoughts in the comment section. Essentially, Terra acted like a Ponzi scheme primarily because more individuals investing in it was the only way for it to expand and for its tokens to increase its value. To put it another way, Luna's price and UST's supply increased simply because it was becoming more expensive, rather than because more individuals were using it as payment for goods and services. Similarly, LUNA had an inherent structure that encouraged growing speculative activity rather than being used more and more as a utility token of any blockchain with practical applications. The connection between UST and Luna gave Terra its Ponzi-like characteristics, as both looked to expand at the same time, even if neither was being used for anything besides speculation. As an illustration, Terra created the UST stablecoin by igniting Luna, which was intended to be used to prop up the price of UST anytime it fell below $1. In addition to this Luna burning, the overall supply of Luna was once limited to 1 billion. However, that limit has now been removed. As a result, it was frequently referred to as a declining cryptocurrency, which encourages traders to buy it. They were additionally encouraged by Terra's constant expansion of the UST supply, whose circulation climbed from around $3 billion in early November to $18.7 billion until its demise in early May. And did the increase in UST supply result from an increase in the spontaneous demand for it? Actually, not quite, because the Terra-based Anchor protocol called for UST to be used mostly for staking. In a vicious cycle, Anchor once offered returns of 20% for staking UST, and Terra paid these returns by creating a new UST. The issue is that, particularly during market downturns, the entire system may implode if this rate of development were to stop. The foundation for UST was continually put to the test, and declining cryptocurrencies overall caused losses for Luna as well. Holders were panicking because their portfolios were losing value because of a few significant withdrawals from Anchor, which quickly led to a rush to sell UST. The most crucial point to remember when it comes to UST is that it only functions and draws holders when it is increasing, because it has no other purpose or value. If it begins to fall, the entire house of cards will fall very rapidly. With that said, how can you determine whether a cryptocurrency is a Ponzi scheme? Terra offers a crucial case study that demonstrates how to identify a cryptocurrency that is a Ponzi scheme. Although the majority of cryptocurrencies are unlikely to be deliberate Ponzi schemes, many could wind up exhibiting Ponzi-like traits significantly with their underlying tokenomics. The key principle to keep in mind is that if a cryptocurrency's primary draw or selling point is that people are buying or investing in it, then it is essentially a Ponzi scheme. This is mainly because there won't be anything to support it in the unlikely case that it falls. According to the beliefs of many cryptocurrency doubters, this fundamental tenet disqualifies important tokens like Bitcoin or Ethereum from being Ponzi schemes. For instance, countries that are experiencing inflation are increasingly using Bitcoin, whereas Ethereum is the leading utility chain and provides a wide range of practical use cases. Other red flags to look out for, according to the U.S. Securities and Exchange Commission, are as listed below. 1. When a project features high returns with little to no risk. Any cryptocurrency project or platform that guarantees continuously high returns, like Terra's 20% yield via Anchor, ought to be taken very seriously. 2. If the tactics are too intricate and sometimes secretive. If you are unable to comprehend the economics or business strategy of a cryptocurrency, or find it to be incredibly difficult to understand, it's possible that its developers are concealing something. And 3. If receiving payments comes with troubles. Be wary if you run into problems and find it difficult to get paid for a project. Investors should be able to determine whether a new cryptocurrency has Ponzi-like characteristics and is thus a significant risk by taking these criteria into account while examining it. Always conduct independent research. Thank you for watching. If you enjoyed this video, then you'll love the other videos we have on this channel. Check them out. Remember to drop a like on this video by giving it a thumbs up, and share your thoughts in the comment section. Also, don't forget to subscribe if you're new to this channel, and turn on the notification button so you'll be one of the first to be alerted whenever we upload a new video.